Hello. It's been an interesting few days for gold, and I'm here with Charlie Gibson, who's head of Edison's mining team and an expert on the subject, to discuss what things are going to affect it in the year ahead of us in 2015, and also what to make of some of the important recent events. Charlie, welcome.
Julian, thank you.
I thought we'd start by having a brief recap on the thesis of your last big note on the subject, Gold 5. Just in a very short space of time, please.
Yeah, I produced this about a year ago, a bit more than a year ago now, and the basic thesis is you can look at gold in terms of its traditional historical relationship with prices in America. So what you're looking at is effectively a correlation between the gold price and inflation, and you can look at the same thing between the gold price and the monetary base. You would expect that historically there was an exact relationship between the number of dollars in circulation and the amount of gold that the Federal Reserve had. All right, that broke down probably twice, but most recently in the history in 1971. But you would expect the market, particularly for a real asset like gold, to be related in some way, particularly a monetary asset, to the number of dollars in circulation, and how the values of those two things change will depend on how much gold supply changes by and how much the dollar supply changes by. Now, gold in the last few years, the supply has been pretty well, supply and demand have been, I'd say, constant. They haven't changed much within the historical trend. The supply of dollars has changed absolutely hugely beyond all recognition compared to anything we've ever had before, certainly in the last 50 years, either in absolute nominal terms or in percentage terms or indeed in real terms.
And is that perhaps is the fact that there are a lot more dollars in the world now, but that the price of gold has not changed as much as the number of dollars has, is that perhaps because all the new money that's been printed hasn't actually entered everywhere
circulation? Exactly. Now, this is the key point to the next article, if you like, the next report, is that traditionally, the total monetary base is almost exclusively made up of notes and coins in circulation. In fact, the monetary base is made up of two things. It's notes and coins in circulation and the holdings that the banks have at the central bank. Now, this, if you like, you could describe this as money that could be in circulation. But traditionally, it's been something like, it's averaged more than 59% since 1959, and it's got over 90%. Notes and coins in circulation as a percentage of the total monetary base. Now, since then, it has absolutely collapsed to about a third. So of the 4 trillion monetary base, only about 1.3 trillion is now notes and coins in circulation. So you've got the Fed printing 3.2 trillion, but only 0.5 trillion of that has actually come out into the real economy. And so that's one of the things that I think has held back prices, has held back inflation in the United States, and also probably because of that held back gold as well. Gold often seen as a hedge against inflation. Well, if it's not obvious that the inflation is coming through, then people are going to be not as enthusiastic about gold as they have been in the past, or perhaps they should be. My thesis is that I expect that at some point that it will come out, and that that will be part of the expression, if you like, of the printing of money that we've had into the real economy.
Interesting. And what about in other parts of the world economy? So you look at Japan and the European Central Bank, both probably likely to do some quantitative easing of their own in 2015. What effect would that have?
I think that's going to have a very compounding effect because until recently in the global economy, if you like, in my world, there is a monetary crisis or a financial crisis. There are two ways of getting out of it. You can inflate your way out of it, as we did in the 1970s. You can deflate your way out of it in the 1930s. You can argue, and academics do, about which is better. I don't want to join that argument, but what we have had recently is that the US and the UK in particular have looked to inflate their way out. That is to say, if you like, to put it in simple terms, what you've got is a situation where you would expect salaries to stay the same and prices to double, or whereas the Europeans, and in particular, have followed a deflationary path, which is more akin to prices stay the same and your salary halves. It's that sort of thing. Now, in real terms, you might argue that they were the same things, and that's why I was saying about the academics getting into this argument. However, it looks increasingly as though the Europeans are now going to follow the Americans down the inflationary path, and that being the case, if you can imagine, one of the things that's held back probably inflation and prices in the US is the fact that the Eurozone has, or certainly the periphery of the Eurozone, has been going through this deflationary phase. Now, if that suddenly turns to inflationary, then if you like, you have the sort of the two big monetary authorities in the world pursuing the same sorts of policies in tandem, and so there'll be less balancing and more mutually supportive. So I think that is one of the things that if you like, argues in favour of a more inflationary future than we've had in the moderately recent past.
And I suppose we can't really not mention two things now. One is oil, and the fact that the price of a barrel of oil is pretty much halved in the last couple of months, and the effects of the Swiss franc being unpegged from the euro. Oil first, obviously a huge contributor to inflation and the value of people's salaries. Similar kind of effect as any other form of inflation?
Similar. I mean, in my opinion, oil is the sort of, it depends on how you see the causation, but a lot of price rises, in my opinion, are derived from oil being the primary energy source in the global economy. So I think oil is, if you like, the causative factor behind a lot of prices. Very good news in a way that the price of oil has fallen, certainly for the real economy, for Western economies, for non-oil producing economies, because it keeps inflation down, and that allows the banks, then the central banks, to maintain a looser monetary policy for longer. And I think that's part of what you're seeing with the Federal Reserve at the moment, where expectations for their raising central rates have been put back from the beginning of this year, certainly to the end of this year. And to be honest, barring any upsets, and I wouldn't rule those out for the reasons we've talked about, but barring any upsets, I think actually you might find that it could go out a lot longer than that even. So that's one, if you like, reason why the fall in the oil price is good, is a positive environment for gold. The other factor or way in which it's important, of course, is for the producers and indeed the explorers. It lowers their cost base substantially. So oil and gold have traditionally had a very strong correlation. I think for the reasons I've outlined, is because oil determines where the cost base is, the cost curve is for the industry, and that to some extent determines where the gold price can be, or certainly determines where the floor of the gold price can be. So if you like, this is margin relief. We had margins squeezed in the last couple of years when oil was strong and gold was weak. We now got the reverse situation, where if you look at what happened to the Swiss National Bank yesterday and gold going up by almost 2%, we got an environment where the winds seem to be blowing in gold's favour and against oil at the moment. So margins are widening for the producers, and it's giving
the gold producers.
For the gold producers, absolutely. Certainly, they're definitely not the oil producers. For the gold producers, yeah, there's margin relief, and for the explorers, it's taking the pressure off their cost base.
Yeah, and so just to quickly wrap up, really, the outlook for gold equities in 2015, therefore positive with caution.
Yes, absolutely. I mean, it probably will be driven to a large extent by the gold price. However, I would say also, if you look at gold equities at the moment, how they're priced, particularly the explorers are valued now at only about, the average value of an ounce of gold in the ground is about $12 for an explorer. And that is about 1%, slightly less than 1% of the price of gold. It is not much more than the cost of discovery. So that would seem to be something of a floor. You can always say it can go down 100%. Yes, it can go down 100%. It could go down from 12 to 0. You're right. It would be fairly unprecedented. But I would look on the upside and say that in recent history, by which I mean 2011, those same explorers were trading at 10% of the price of gold. And so, if you like, as I see it, you've got 10 times upside and 1 times downside. And I think that's a bet worth taking.
Yeah, noted. Charlie, that's very interesting indeed. Thank you very much. If you'd like any more information, please do contact Edison or look on our website.